All right. So, welcome, guys, to the chapter 4 Introduction to the Stock Markets. We have been on the wonderful series of stock markets, and today on the chapter 4, we'll be talking about the IPO markets, origin of business, the venture capitalist, and a lot more things that we need to talk about. So, next page. Now, the initial three chapters has set the background on some of the basic market concepts which you need to know at this stage. It has become imperative to address a very basic question: why do companies go public? Now, a good understanding of this topic lays down a sound foundation for all future topics. We will learn new financial concepts during the course of this chapter. Next page. Next page. Origin of a business. Before we jump ahead to seek an answer as to why companies go public, let us spend some time figuring out a more basic concept, the origins of a typical business. To understand the concept better, we will build a tangible story around it. Let us split the story into several scenes just so that we get a clear understanding of how the business and the funding environment evolves. Now, let us imagine a budding entrepreneur with a brilliant business idea to manufacture highly fashionable organic cotton t-shirts. The designs are quite unique, has attractive price points, and the best quality cotton is used to make these t-shirts. Now, it is confident that the business will be successful and is all very enthusiastic to launch the idea into a business. Now, as a typical entrepreneur, he's likely to be hit by the typical problem: where would he get the money to fund the idea? Now, assuming the entrepreneur has no business background, he would not attract any serious investor at the initial stage. Now, chances are that he would approach his family and friends to pitch the idea and raise some money. He could approach the bank for a loan and, as well, but this would not be the best option. But let us assume first that he pours in his own money and also convinces two of his good friends to invest in the business, because these two friends are investing at the preview or revenue stage and talking a blind bet on the entrepreneur. They will be called the angel investors. And of course, we should note that the money from the angels is not a loan, it is actually an investment made by them. All right, next page. So let us imagine that the promoter, along with the angels, raise INR 5 core cap in capital. This initial money that he gets to kickstart his business is called the seed fund. Now, it is important to note that the seed fund will not sit in the entrepreneur's, also called the promoter's, personal bank account, but instead it will sit in the company's bank account. Once the seed capital hits the company's bank account, the money will be referred to as the initial share capital of the company. And in return of the initial seed investment, the original three promoter plus two angels will be issued share certificates of the company, which entities them at ownership in the company. So the only assist, or rather asset, that the company has at this stage is cash of INR 5 CRs. Hence, the value of the company is also INR 5 CRS. This is called the company's valuation. Issuing shares is quite simple. The company assumes that each share is worth RS10, and because there is RS5 core as share capital, there has to be 50 lakh shares with each share worth RS10 in this context. Now, RS10 is called the face value, FV, of the share, but the face value could be any number. If the FV is RS5, then the number of shares would be 1 CRORE, so on and so forth. The total of 50 lakh shares is called the authorized shares of the company, and these shares have to be allocated or allotted amongst the promoter and two angels, plus the company has to retain some amount of shares with itself to be issued in the future. So now let us assume that the promoter retains 40% of the shares and the two angels get at least 5% each, and the company retains 50% of the shares. Now, since the promoter and two angels own 50% of the shares, this allotted portion is called issued shares. Are we following? Next page. Now, we have the initial shareholding pattern on the table. At the extreme, we have the serial number, and number of shareholders following, number of shares following, and the percentage holding. So the promoter getting 2 million, which is about 40%, India 250,000, India 250%, 250,000, which is about 5% each equivalent. Now, the shareholding pattern of this company would look something like this. Please note that the balance 50% of the shares, totaling 2,500,000 equity and shares, are retained by the company. These shares are authorized by not but not allotted. So now, backed by a good company structure and a healthy seed fund, the promoter kickstarts the business operations. He wants to move cautiously, hence he decides to open just one small manufacturing unit and one store to retail his product. Next page, please. The venture capitalist. His hard work pays off and the business starts to pick up at the end of the first 2 years of operations. Now, the company starts to break even. The promoter is now no longer a rookie business owner. Instead, he is more knowledgeable about his own business and, of course, more confident. Now, backed by his confidence, the promoter now wants to expand his business by adding one more manufacturing unit and few additional retail stores in the city. He chalks out the plan and figures out that the fresh investment needed for his business expansion is INR 7 CRS. He is now in a better situation when compared to where he was 2 years ago. Now, the big difference is the fact that his business is generating revenues. Healthy inflow of revenue validates the business and its offerings. So he is now in a situation where he can access reasonable saving investors for investing in his business. Now, let us assume he meets one such professional investor who agrees to give him 7 CRS for a 14% stake in his company. The investor who typically invests in such early stage of business is called a venture capitalist, and the money that the business gets at the stage is called a Series A funding. Now, after the company agrees to allot 14% to the VC from authorized capital, the shareholding pattern looks much like this. Next page. Now, we're looking at the second stage shareholding pattern. Uh, Name of shareholder, promoter, about 2 million shares, 40% holding, and 250,000 follows next, 5% each. And the venture capitalists, 700%. Note that the balance of 36% of shares is still retained within the company. And of course, a very interesting development has taken place. Now, the VC valuing the entire business at INR 50 CRS by valuing is 14% stake in the company at INRS 7 CRS. With the initial valuation of 5 CRS, there is a tenfold increase in the company's valuation. And this is what a good business plan validated by a healthy revenue stream can do to the businesses. It works as a perfect recipe for wealth creation. Next page. Now that brings us to the end of today's webinar. And I think we have gained something insightful on IPOs for chapter 4. We'll be diving deeper next week, Friday, on something much more bigger as we are getting more, as things are getting more interesting about the stock market. So stay tuned and see you guys again next week. Happy weekend.